If you've been watching the precious metals space lately, the last week probably felt like a trap door opened under silver. One moment it's holding up near the highs, the next it's down roughly $10 in days. And suddenly people are asking the same question in every direction. Is this just a dip? Or is something bigger breaking? Because here's what makes this move feel different. Silver didn't just pull back a little. It dropped hard, it dropped fast, and it did it in a way that shook confidence. And to make it even more frustrating for anyone who bought earlier this year, silver isn't just down on the week, it's now down on the year too. That kind of reversal messes with sentiment, shakes out weak hands, forces leveraged traders to liquidate, and sets the stage for the kind of volatility that can cut both ways.
Let's start with the price action, so we're grounded in what the market is actually doing. At the moment, we're looking at silver around $70.58, down about $2.71 on the day, close to a 4% hit in a single session. Gold is also sliding, around $4,570, down roughly $84, just under 2%. The direction is the same, down, but the intensity is different. Silver, as usual, is the one taking the punches. Now zoom out a little. On a year-to-date basis, silver started the year around $71.59. That matters because it means the entire year's progress has been wiped out and then some. And when you look at the one-week chart, it gets even uglier. About a week ago, silver was above $80 an ounce. So in 1 week, we're talking about an approximate $10 drop. That's not a gentle correction. That's a move that forces people to react. When silver moves like this, it also changes how it looks compared to other major assets. You can literally watch it slide down rankings by market cap as the price falls. That doesn't mean the metal suddenly became less important, but it does influence perception and positioning, especially for funds and systematic strategies that track performance and momentum. And then there's the gold to silver ratio. As silver weakens faster than gold, the ratio climbs. Right now, it's moved above 65, which is a big clue about what's happening under the hood. Even though both metals are falling, silver is being treated as the higher beta, higher risk cousin. When markets get nervous, or when macro conditions turn against metals, silver usually exaggerates the move. So why is this happening? The simplest way to explain it is that two big macro forces have turned into headwinds at the same time: a stronger dollar and a repricing of interest rate expectations. And those are not small forces. They are the kind of drivers that can overpower bullish narratives for weeks or even months, even if the long-term case for metals remains intact. First, the strong dollar. A stronger US dollar is almost always a problem for precious metals in the short term. Gold and silver are priced globally in dollars, so when the dollar rises, it effectively makes metals more expensive for non-dollar buyers. That tends to reduce demand at the margin. Beyond that, a strong dollar often signals tighter financial conditions, risk-off positioning, and global capital flowing into dollar-denominated assets for safety or yield. All of that can weigh on metals. And lately, the dollar strength has been reinforced by geopolitical uncertainty. In times of conflict or escalation, there's this tug-of-war. One side of the trade is buy gold because fear is rising, but the other side is buy dollars because the world wants liquidity and the US dollar still functions as the global settlement asset. In the very short term, the dollar can win that battle, especially if rates are high and US yields are attractive. Which brings us to the second major driver: interest rates. A lot of the earlier bullishness in gold and silver depended on the idea that the rate cut cycle was coming, and coming soon. Precious metals love falling real yields and an easier Fed. Why? Because gold and silver don't pay interest. When rates are falling, the opportunity cost of holding metals drops, and money tends to rotate into hard assets. But when the market starts to believe rate cuts are delayed, or worse, that hikes are back on the table, metals often reprice lower. Right now, inflation is not cooperating. It's sticky enough that the market has been forced to price out some of those earlier, optimistic rate cut expectations. Even if the base case is rates hold, what matters is the direction of the surprise. If traders were positioned for easing and they suddenly have to consider tightening or higher for longer, you get violent repositioning. Look at how this shows up in probability markets for upcoming central bank meetings. Even a 14.5% chance of a rate hike at the next meeting, whether it happens or not, changes behavior. Markets are forward looking. They don't wait for the decision, they trade the probabilities. That means gold and silver don't just react to what the central bank did last meeting, they react to what traders think the central bank might do next. And when you extend that out to year end, the picture becomes even more complicated. There's only around a 50% chance that rates remain where they are. The rest of the probability distribution is spread across one hike, two hikes, and even a small chance of three hikes before the year is out. That is not the environment where gold and silver get a clean, easy rally. At minimum, it creates friction. Now layer in war-driven inflation risks. Many people assume war automatically means gold up. Sometimes it does, but it's not guaranteed in the short run. Here's why. If a conflict boosts energy prices and supply chain costs, inflation can rise. Rising inflation, in turn, makes the central bank more hesitant to cut and more willing to keep policy tight. Tight policy supports the dollar and supports yields. That can suppress metals temporarily, even in a world that feels like it should be bullish for safe havens. So you end up with this weird but real short-term setup. Geopolitical stress pushes inflation up, inflation keeps rates higher, higher rates support the dollar, and the combination hits gold and silver. It's counterintuitive if you only think fear equals gold, but markets are more mechanical than that. They price liquidity, yields, and policy expectations, not just emotion. That's why you'll see comments floating around like, rate cuts are being priced out due to inflation and conflict. And as long as the war drags on, inflation stays hot, the dollar stays strong, and metals remain under pressure. Whether you agree with that take or not, it's describing a real mechanism that can drive prices. Now, silver is special because it's not just a monetary metal, it's also an industrial metal. That makes it more sensitive to growth expectations, recession fears, and general risk appetite. When markets start to worry about recession, industrial demand expectations can soften. When markets worry about sticky inflation and tighter policy, financial conditions tighten. Either way, silver can get hit from both sides, monetary headwinds and industrial demand uncertainty at the same time. And there's also positioning. Silver markets can be thin compared to other major assets, and they can be heavily influenced by futures positioning, algorithmic trading, and margin dynamics. When a fast drop begins, leveraged longs can get forced out. That creates more selling, which pushes price lower, which triggers more stops and margin calls. That's how you get the waterfall feeling, where price doesn't just drift lower, it falls in steps. This is why some traders are now watching specific levels closely. Once silver slipped into the high $60s, the conversation immediately became, can $66 hold, or are we going to see $64? These aren't magical numbers, but they are psychologically important zones where liquidity clusters tend to form. If price breaks a widely watched level, it can accelerate the move because so many participants are reacting to the same thing. At the same time, there's a different camp watching $70 as a potential line in the sand. There have been claims that big money stepped in around that area, large banks, institutions, or even state-related flows, creating a kind of soft floor. Some point to observations that when silver dipped below $70, it popped back up quickly. That kind of action can suggest that demand is waiting there. But it's crucial to be honest about what a floor really is. A floor isn't a guarantee, it's just a zone where buying has shown up before. If macro conditions keep pressuring metals, strong dollar, rising yields, rate cuts delayed, then even strong support levels can break. In fact, repeated tests of a level can weaken it. The more times price hits the same support, the more likely it is that eventually it gives way, because buyers get absorbed. There's also another narrative that occasionally surfaces in these moments, forced selling by certain buyers who are accumulating gold or silver but suddenly need dollars. The argument goes like this. If certain countries or large entities face trade constraints, obligations, or liquidity needs, especially during conflict or sanctions-driven disruptions, they may sell some metal to raise dollars. Whether or not that's happening in any large way is hard to prove from the outside, but the concept is not crazy. In a dollar-based system, when funding stress rises, dollars become the asset everyone needs right now, and selling anything liquid becomes an option. That said, even if there is some short-term forced selling, it doesn't necessarily change the long-term direction. It just creates turbulence on the path. And that takes us to the bigger question: where do metals go from here? Short term, you have to respect the possibility that the pain isn't over. If the dollar stays strong, if yields keep rising, if inflation stays sticky, and if the central bank remains hawkish or even mildly hawkish, gold and silver can drift lower or stay under pressure longer than most people expect. Markets can stay irrational longer than a trader can stay solvent, and they can also stay macro-driven longer than a narrative can stay popular. Silver, specifically, can overshoot to the downside because it's volatile. A $10 move in a week can be followed by another sharp move, either down or up. You cannot assume that because it already fell, it must bounce immediately. It might bounce, but it might also chop sideways and grind people out for weeks. If you're watching the gold-silver ratio, a rising ratio suggests silver could remain relatively weaker in the near term, especially if the environment is risk-off and liquidity-driven. If the ratio keeps climbing, it often signals that silver is being sold more aggressively than gold, and that can persist until something changes in macro. So, what would change the macro? The biggest catalyst would be a clear pivot in rate expectations. If inflation data cools decisively, if economic data weakens sharply, or if financial markets start to crack in a way that forces policymakers to prioritize stability over inflation fighting, then the market will front-run easing again. That would likely weaken the dollar, reduce real yields, and give metals a strong tailwind. There's also the possibility of a financial accident. If yields rise too far, too fast, they can break something: equities, real estate, credit markets, or banking liquidity. If that happens, policymakers may be pushed toward rate cuts and liquidity injections, even if inflation is still a problem. That's the stagflation nightmare scenario: weak growth with high inflation, where central banks are cornered. In that kind of scenario, gold and silver can explode higher because the market starts to price not just easier policy, but a loss of confidence in the ability to contain inflation without breaking the system. Historically, when the market believes the only solution is money creation, hard assets become more attractive quickly. But until that happens, metals can remain trapped between two forces: long-term fear and short-term policy reality. And this is where many investors separate time horizons. Short-term can be ugly. Long-term can still be bullish. You can believe both at the same time without contradicting yourself. Long-term, the bullish case for metals is still built on the same foundation: debt, deficits, money supply growth, and the political difficulty of austerity. The U.S. national debt is now over $39 trillion for the first time ever, and projections out decades suggest numbers that are almost hard to comprehend. When debt grows faster than the economy, the system tends to rely on some combination of inflation, financial repression, currency debasement, and rolling over obligations. Those are conditions where gold and silver often perform well over time, even if they experience brutal drawdowns along the way. On top of that, broad money supply measures have been pushing to new highs. More dollars in the system over time generally means the unit of currency buys less, even if the effect comes in waves. People argue about timing, but the long-run direction of purchasing power in fiat currencies has historically been down. That's the core reason many people hold metals, not because they expect a straight line up, but because they expect currencies to steadily lose value over long periods. Then you add the fiscal reality of conflict and geopolitics. Wars and prolonged global tensions are expensive. They can require hundreds of billions quickly, and over time, the numbers can balloon. Financing that through taxes is politically painful. Financing it through debt is easier in the short term. Financing it through monetary accommodation is the temptation when the system gets stressed. Again, that doesn't mean metals go up every week. It means the long-run environment keeps producing reasons to own them. So what do you do with this as an investor or buyer? One approach is to stop trying to nail the exact bottom. Bottom calling is emotionally satisfying, but it's statistically difficult. A more practical method is to keep a disciplined strategy and let volatility work for you instead of against you. If you're buying physical metals or building a long-term position, dollar cost averaging can make sense. You buy over time, you reduce the risk of perfect timing, and you avoid the psychological trap of going all in at one price. If price falls, you're able to buy more at a discount. If price rises, you've already established exposure. That doesn't mean you ignore risk, it means you control it. You avoid making huge purchases based on a single day's move. You avoid assuming that a support level must hold. You respect that silver can move violently and unpredictably. In a fast drop like this, another smart idea is to think in tranches. Instead of one big buy, you split buys across levels or across time. If silver is near $70 today and it drops to $66 later, you still have capital available. If it drops to $64, you can continue. If it reverses and runs, at least you started building. This removes the need to be right about the exact path, and the same logic applies to gold. Gold is usually steadier than silver, but it's still sensitive to real yields and the dollar. If the market continues to price out rate cuts, gold can remain under pressure. If something breaks and the market prices in easing again, gold can move quickly. Now, a reality check. Not every downturn is a massive buying opportunity in the immediate sense. Sometimes the market is telling you that conditions have changed. The opportunity exists if your time horizon is long enough and your thesis is still valid. But you still need patience because even if the long-term direction is up, the path can include painful drawdowns and long consolidations. So here's a balanced way to frame the situation. In the short term, the most likely environment is more volatility and potentially more downside, especially if the dollar stays strong and yields stay elevated. Silver could test lower levels, and gold could stay soft. In the medium term, everything depends on inflation data, growth data, and whether financial stress forces policymakers to shift. In the long term, the debt and currency backdrop still supports the case for owning metals as a hedge, especially if you believe money printing and deficits are not going away. And that's why you can see two things at once: painful price action right now and a long-term setup that still looks constructive. It's not comfortable, but markets rarely reward comfort. The key is to decide what you are: a short-term trader, a medium-term speculator, or a long-term allocator. Traders need tight rules and risk controls because silver can wipe out bad leverage quickly. Long-term buyers need patience and a process because price can stay depressed longer than expected before the larger trend resumes. For now, the market is doing what it always does in moments like this. It's forcing people to prove whether they actually believed their thesis or whether they were just chasing momentum. So where do you think this goes next? Do you think silver finds real support around the $70 zone and rebounds? Or do you think it continues to grind down toward the mid-$60s first? And what do you think matters more in the next few months? Dollar strength, interest rates, or the risk that something in the financial system breaks and forces a pivot?